You know those unlimited breadsticks at Olive Garden? Or maybe a perfectly cooked steak from LongHorn Steakhouse? Well, what if I told you that they, along with some really fancy fine dining spots, are all part of the same big family? Yep, they're all run by one company, Darden Restaurants. And today, we're going to pull back the curtain on their latest financial report to see what's really cooking behind the scenes. I mean, look at these logos. You know these names, right? They're everywhere. But these brands aren't just serving up food, they are generating a massive amount of data. And that data tells a really fascinating story, not just about their business, but about our whole economy. And yeah, even our own spending habits. So, what's the big story? Well, to put it simply, Darden just served up a quarter that totally crushed what Wall Street was expecting. So let's dig into the three big numbers that really tell you everything you need to know. Okay, first up, the sheer scale of this thing. $3.1 billion in total sales for the quarter. Just stop and think about how many plates of pasta or how many steaks that actually is. It's huge. This number tells us one simple thing. Their restaurants are packed. And get this, that huge number isn't even standing still. It's growing. Sales are up 7.3% from this exact same time last year. That's a really powerful signal that people still want to eat there and that their expansion is working. And finally, we get to the bottom line. Adjusted earnings per share hit $2.08. The easiest way to think about this is like the slice of the profit pie that goes to each owner of a share. It's a really solid number that shows investors the company isn't just busy, it's making serious money. Hey, and you don't just have to take my word for it. The CEO himself, Rick Cardenas, pointed out that every single segment saw growth, not just one or two, all of them. That's a massive vote of confidence, and it kind of sets the stage for us to look at exactly how they measure that success. So when the CEO says every segment is delivering, what does that actually mean? How are they measuring it? I mean, a company can always look like it's growing just by opening a bunch of new restaurants, right? But that doesn't tell you if the places that are already open are doing well. For that, you need a special metric. And this is it. Same restaurant sales. This is probably one of the most important ideas to get. It basically filters out all the noise from brand new locations and tells you, apples to apples, how the core, established restaurants are performing compared to last year. It is the true test of a brand's health and its staying power. And here's that idea in action. Okay, look at this. As a whole, Darden's same restaurant sales grew by a really strong 4.3%. But this is where it gets interesting. When you break it down, you can see some brands are really pulling more weight than others. I mean, look at LongHorn, an incredible 5.9% growth. Now that table gives us a pretty good hint, but let's really put the spotlight on the two biggest names in Darden's lineup. You've got Olive Garden, which is just a giant, but was it the actual top performer this quarter? And boom, here's the answer. While Olive Garden put up a very, very respectable 4.7% growth, LongHorn Steakhouse was the real star, just sizzling ahead with almost 6% growth. And what this tells you is super important. Darden isn't a one-trick pony. It has multiple engines firing and driving its growth. But, these fantastic results, they don't tell the whole story. Because Darden, just like every other restaurant out there, is dealing with some pretty serious economic headwinds. It wasn't all easy. And the biggest headwind of all? Inflation. We all feel it every time we go to the grocery store, right? Well, imagine you're a company buying food on the insane scale of Darden. It is a massive challenge. So how bad is it really? Well, take a look at this. The cost of two of their most important ingredients, we're talking beef and seafood, is expected to see low double-digit inflation. Ouch. That is a significant hit to their profits. Now, there's a little bit of good news with dairy and oil costs actually going down, but the pressure from those protein prices is intense. So how do you fight back against that? Well, Darden leans on what it calls its 4 competitive advantages. This is their playbook. First, because they are so huge, they can negotiate way better prices on food than the little guys. They also use a ton of data to figure out what you and I want to eat, and they adjust their menus to control costs. They are also masters at planning their supply chain. And finally, they invest in their people to make sure the restaurants run super efficiently. This is how they win in a tough environment. Okay, so all of this strong performance, this really smart strategy, it gives them a lot of confidence to put out a very positive forecast for the rest of the year. Let's take a look at what they're telling investors to get ready for. First off, they're not done building. They plan to open another 65 to 70 new restaurants. This is a clear signal that they believe there is still a ton of room to grow and plant their flags in new places. They also think that powerful sales momentum is just going to keep on rolling. They're projecting total sales for the whole year to grow somewhere between 8.5% and 9.3%. So yeah, they are definitely not expecting a slowdown anytime soon. And of course, it all comes back to the bottom line, which means more profit for shareholders. They're telling the market to expect full-year adjusted earnings per share somewhere between 10.50 and 10.70. It's their way of saying, yeah, costs are tough, but we've got this and we're going to deliver. So look, Darden is clearly firing on all cylinders. They have a winning strategy for a really complex time. But it kind of leaves us with a bigger question, doesn't it? As these massive, super efficient companies like Darden continue to thrive, what does that mean for all the small, independent restaurants out there? And maybe more importantly, what does it say about what we as diners are going to value most when we decide where to spend our money to eat out in the future?